DeFi, finance without a bank in the middle. This isn't just an idea, it's a model that already moves trillions of dollars in public, verifiable contracts, open for anyone in the world to check right now. In this video, I'll explain what DeFi is, how it works, and why it's important for you. Let's start with the problem. You have a bank account, but the bank decides what you can do with that money, not you. Want to transfer a large amount? The bank chooses whether to approve or block the transaction. Want a line of credit? The bank decides if you deserve it or not. Want to make a transaction at 11 p.m. on Sunday? The bank decides if you can do it or not. If your account is flagged for any reason, it can be blocked without notice. The bank is an intermediary between you and your own money. DeFi replaces this intermediary, not with another company, but with code that runs automatically, without needing anyone's approval, without business hours, or hidden fees. And this code has a name, smart contract. A smart contract is a contract that executes on its own when conditions are met. Think of it like this. You agree with someone that if it rains tomorrow, you pay $10. If it doesn't rain, the person pays you $10. You both need to trust each other or hire a lawyer to guarantee it. In a smart contract, the logic is in the code. When the condition is verified, execution happens automatically, without intermediaries, without the possibility of anyone changing the rules halfway through. This code stays on the blockchain. Now, what does DeFi do with this? DeFi uses smart contracts to recreate financial services without having the bank as an intermediary. In a staking contract, for example, the rules written in it are executed exactly as they were published. Asset swapping? You can swap one token for another directly, wallet to wallet, without going through a centralized exchange. Access to credit protocols, liquidity, and much more, all via public contracts. The logic is always the same, condition plus automatic execution. The code is the rule, and the rule is public. Let's see how this works in practice. There are token swap protocols that are fully decentralized. When you make a swap in this type of protocol, there's no one on the other side processing it manually. A smart contract executes the swap directly between wallets. There are also lending protocols. You deposit an asset as collateral, and the contract releases the credit automatically, without a credit check. And there are protocols that allow you to earn yields on assets deposited in a liquidity pool governed by public contracts. What do all these protocols have in common? The operation happens on-chain. On-chain means that it's recorded on the public blockchain. Anyone can verify every single transaction, every rule, and every balance. No one needs to take anyone else's word for it. Transparency is structural. Now, there are differences between operating via DeFi and operating on a traditional centralized exchange. In a centralized exchange, the company holds your assets. You trust the company. If the company fails or gets hacked, you could lose access. In on-chain mode, you operate directly. Your assets stay in public contracts. The rules are written and verifiable before you confirm any operation. There are also intermediate models, like simplified custody via multi-sig architecture, where a platform handles the technical layer, but each user has an individual on-chain wallet verifiable on the blockchain. The difference from a traditional exchange is that assets and operations are recorded publicly, not in a private database. The DeFi model is at the core of the Inkryptus ecosystem. Staking on Inkryptus works via smart contract. The rules are published on the BNB smart chain and are verifiable on BSC scan before you confirm anything. The issuance of Inky is programmed. 10,000 Inky are issued per day, distributed proportionally among all participants in the staking pool. Here, it's important to understand how this distribution works. The daily issuance is fixed. The more participants join the pool, the more this issuance is divided among them. This means the amount each participant receives may decrease as the pool grows. It's not a guaranteed fixed yield, it's proportional participation in a programmed issuance. This isn't a promise of return. It's a public, verifiable mechanic you can check on BSC scan before joining. Transparency is the key point here. Our contracts are public and verifiable. DeFi is the future that's already working. Trillions of dollars in volume passing through public contracts with no bank in the middle every day. If you want to better understand how to participate, you can explore the Inkryptus ecosystem and start to understand and practice what it means to operate on chain.